Wall Street no longer needs economic growth to make money, and that single fact explains more about modern markets than almost anything else. For most of financial history, growth was the fuel. Companies expanded, productivity rose, wages increased, demand followed. Profits came from making and selling more real things to more people. When growth slowed, markets struggled. When growth stopped, crises followed. That relationship has quietly broken. Welcome to Finance Historian. Before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city and the time you're watching this. I want to see how global this community is. Today, markets can thrive even when the economy stalls. Asset prices can rise while productivity flatlines. Trading profits can surge while real incomes fall. Wall Street doesn't just survive without growth anymore. In many cases, it prefers it. That didn't happen by accident. It happened because the source of profit changed. Modern Wall Street makes its money less from expansion and more from movement. Not from building the economy, but from positioning around it. Not from growth itself, but from volatility, liquidity, and policy response. The system learned that growth is slow, uncertain, and politically constrained. But price movement is fast, predictable, and monetizable. So incentives shifted. The first break came when finance detached from production. As markets grew more complex, more leveraged, and more intermediated, profits increasingly came from transactions rather than outcomes. Trading volume mattered more than long-term success. Balance sheet velocity mattered more than balance sheet strength. Growth became optional. Then monetary policy completed the separation. Central banks didn't just stabilize markets, they reshaped them. By suppressing volatility, backstopping liquidity, and signaling support during stress, they changed risk behavior permanently. Losses became temporary. Drawdowns became buying opportunities. Risk could be recycled instead of written off. That created a new business model. Wall Street stopped needing growth because policy created price action without it. When growth is strong, markets move. When growth is weak, policy intervenes, and markets move anyway. Either way, there is movement, and movement is what gets monetized. This is why modern market rallies often feel disconnected from lived reality. Why asset prices surge while wages stagnate. Why indices hit highs while small businesses struggle. The profits aren't coming from the economy expanding. They're coming from the system reacting. Wall Street doesn't need people to be richer. It needs prices to change. The most important shift wasn't technological. It was structural. Financial markets learned how to extract value from stability itself. Low rates encouraged leverage. Leverage amplified returns. Volatility selling became a strategy. Carry trades became dominant. When growth slowed, these strategies didn't fail, they flourished. Because slow growth justified low rates justified leverage. Leverage created returns, disconnected from fundamentals. That feedback loop replaced growth as the engine. Even crises became profitable. Sell-offs generate volatility. Volatility creates trading opportunities. Policy responses generate rebounds. Rebounds reward positioning. Each cycle becomes self-contained. The economy becomes the backdrop, not the driver. This is why recessions no longer feel like market endings. They feel like interruptions. Brief volatility spikes followed by intervention-driven recoveries. Pain is real for workers, but tradable for capital. That asymmetry is not incidental. It's the result of a system optimized to monetize price, not prosperity. Wall Street no longer waits for growth. It waits for signals. Policy signals, liquidity signals, risk signals. The question isn't whether GDP expands. It's whether capital can move freely and be backstopped when it misjudges. As long as those conditions exist, profits exist. That's why markets can rally on bad news. Weak data implies easier policy. Easier policy implies liquidity. Liquidity implies higher asset prices. Growth becomes a variable, not a requirement. And once a system reaches that point, its incentives invert. Slow growth becomes manageable. Instability becomes opportunity. Stagnation becomes tradable. This is why Wall Street often appears calm in moments that should provoke concern. It's not ignoring the economy, it's operating on a different logic. A logic where growth is optional, but volatility is essential. And that logic has consequences. Once growth stopped being essential, finance stopped caring whether the economy improved as long as markets remained liquid. That's the inflection point most people never noticed. From that moment on, success stopped being measured by expansion and started being measured by extraction. Financial engineering replaced productivity. Instead of asking how to produce more, the system asked how to reprice what already exists. Buybacks replaced investment. Cost-cutting replaced innovation. Balance sheet manipulation replaced revenue growth. None of this required a growing economy. It required cheap capital in cooperative markets, and cheap capital became permanent. Low interest rates weren't just a response to weak growth. They became the strategy for managing it. When growth disappointed, rates stayed low. When growth recovered slightly, rates stayed low. When crises hit, rates went lower still. That locked in a new equilibrium. In that equilibrium, borrowing to inflate asset prices made more sense than investing to grow output. Returns came faster. Risks could be hedged. Losses could be socialized through policy. Wall Street adapted perfectly. Firms structured themselves to profit from leverage rather than expansion. Hedge funds optimized for volatility capture. Banks optimized for balance sheet velocity. Asset managers optimized for flows, not outcomes. Performance became relative, not absolute. You didn't need the economy to grow, or you just needed to outperform someone else in the same stagnant environment. That's how stagnation became survivable for capital. And once stagnation became survivable, it became acceptable. This is why asset inflation accelerated even as real growth slowed. Money had nowhere productive to go, so it went where it could generate returns quickly. Financial assets, real estate, anything scarce enough to absorb excess capital. Prices rose not because value was being created, but because alternatives disappeared. That disconnect widened over time. Markets stopped reflecting the economy. They started front-running policy responses to the economy. Bad data stopped being bad. Weak growth stopped being a warning. Slowdowns became signals for accommodation. The market learned to translate economic pain into financial opportunity. That's the inversion at the heart of modern capitalism. Wall Street no longer needs growth because it has learned to monetize fragility. Fragility creates intervention. Intervention creates liquidity. Liquidity creates price movement, and price movement creates profit. This is also why inequality widened. Asset owners benefited from liquidity-driven price inflation. Wage earners didn't. Productivity gains slowed, but asset values soared. The system rewarded access to capital over participation in production. That wasn't ideological, it was mechanical. When growth stops being the engine, ownership becomes the advantage, and ownership concentrates. The more the system repeats, the more detached it becomes from the real economy. Financial cycles compress, interventions accelerate. The distance between economic cause and market effect grows harder to trace. That's why so many people feel the system is rigged without being able to explain how. It isn't rigged in the sense of conspiracy, it's optimized. Optimized for a world where growth is scarce, volatility is constant, and policy is reactive. In that world, Wall Street doesn't need the economy to improve. It needs it to threaten to get worse. Because threats justify action. Action moves markets. Markets generate returns. That's the loop. And loops like this don't break easily because everyone inside them adapts. Policymakers rely on markets to transmit stimulus. Markets rely on policymakers to stabilize risk. Each side reinforces the other. The real economy becomes secondary. That's why long periods of low growth no longer feel like emergencies. They feel like the baseline. And baselines shape behavior more than crises ever do. But this system has a weakness. It depends on confidence and intervention. If markets ever doubt that policy can stabilize outcomes, the logic collapses. Growth suddenly matters again. Fundamentals reassert themselves, and repricing becomes violent. That's why this model is resilient, but not permanent. It works as long as belief holds. And belief, once questioned, doesn't return easily. That belief hasn't broken yet. But it's being tested in ways that didn't exist before. For decades, the assumption was simple. If markets wobbled, central banks would step in. If growth slowed, liquidity would compensate. If risk mispriced, time and policy would smooth it out. That assumption worked because the scale of intervention was always sufficient relative to the size of the problem. That balance is changing. Each cycle requires more intervention to achieve the same stabilizing effect. More liquidity, larger balance sheets, stronger signals. The system still responds, but the response has diminishing returns. That's the quiet tension beneath modern markets. Wall Street doesn't need growth, but it does need belief that the backstop is infinite. That belief allows leverage to function. It allows risk to be recycled. It allows fragility to be monetized instead of feared. And once that belief weakens, the entire profit model changes. Because without confidence in intervention, volatility stops being opportunity and becomes danger. Liquidity stops being abundant and becomes conditional. Price movement stops being tradable and starts being destabilizing. That's when growth suddenly matters again. And the economy, which has been sidelined for years, reasserts itself violently. This is why the system works so hard to preserve the illusion of control. Forward guidance, emergency facilities, carefully worded statements. Everything is designed to keep markets anchored to the idea that someone is in charge. Markets don't need certainty, they need credibility. But credibility isn't infinite. It's consumed every time policy is used to offset structural weakness. Every bailout, every rescue, every liquidity injection solves an immediate problem at the cost of long-term trust. The trade-off has been accepted because the alternative looked worse. Wall Street adapted to that trade-off faster than anyone else. It learned to treat policy as a feature, not a risk, to position ahead of it, to price it in, to profit from the gap between economic reality and financial response. That's why markets can feel detached from society, because they are no longer pricing outcomes, they're pricing reactions. But reaction-based systems are inherently unstable. They depend on timing. They depend on coordination. They depend on confidence that reactions will always arrive fast enough. The moment one doesn't, the repricing is brutal. This is why Wall Street's independence from growth is not a sign of strength. It's a sign of reliance. Reliance on a framework that assumes volatility can always be contained and losses can always be managed. History suggests that assumption holds until it doesn't. When it fails, it doesn't fail gradually. It fails at the point where intervention loses credibility, where markets stop believing the response will be sufficient, timely, or effective. That's when growth comes roaring back into relevance. Not because it improved, but because its absence can no longer be masked. So Wall Street no longer needs growth to make money, but it does need faith. Faith in liquidity, faith in policy, faith in a system that has learned to monetize stagnation. That faith is still intact. For now. What makes this moment different from past cycles is that the gap between Wall Street and the real economy has become too visible to ignore. For years, that gap could be explained away. Technology would fix it. Productivity would catch up. Globalization would smooth it out. Policy would bridge the rest. Now those explanations feel thinner. Productivity growth remains uneven. Demographics are no longer favorable. Global trade is fragmenting, not integrating. And yet markets still function as if growth is optional. That contradiction can persist longer than people expect. But it cannot persist forever without consequence. Because when finance detaches completely from economic reality, it stops allocating capital efficiently. It starts allocating it defensively, preserving value rather than creating it. That's when stagnation becomes self-reinforcing. Companies stop investing because returns are easier to manufacture through financial channels. Governments rely more on stimulus because organic growth disappoints. Central banks are forced to choose between supporting markets and risking inflation. Each choice solves a problem in the short term and deepens it in the long term. Wall Street thrives in this environment because it understands how to arbitrage time. It profits today from problems that won't fully materialize until tomorrow. It monetizes volatility now and leaves adjustment for later. But later always arrives. And when it does, the repricing isn't about earnings or GDP, it's about trust. Trust that the system can continue to function without growth. Trust that intervention can substitute indefinitely for expansion. Trust that asset values can be sustained without underlying progress. If that trust cracks, even slightly, the logic holding markets together changes. Volatility stops being something to sell. Leverage stops being cheap. Liquidity stops being assumed. At that point, Wall Street doesn't just need growth again, it needs it urgently. And that's the irony at the heart of the system. By learning to make money without growth, Wall Street has made itself more vulnerable to the moment growth truly disappears. Because when that happens, there's no policy response large enough to replace what was lost. Growth can be postponed. It cannot be eliminated. For now, the system continues. Markets trade, profits are made, interventions work just well enough. The disconnect persists because belief persists. But belief is not an asset you can print. And when it weakens, the transition back to fundamentals is not smooth. It's violent. It's redistributive. It punishes the very strategies that thrived on detachment. That's why understanding this shift matters. Wall Street no longer needs growth to make money, but the system it operates within still does. And when that contradiction finally resolves, it won't do so quietly. It will do so in a way that reminds everyone why growth mattered in the first place.